Well, welcome everyone to today's webinar titled One Big Beautiful Bill Act, Uncovering Opportunities in the New Tax Law. I'm Molly Getz, CFP, Partner and Practice Lead at Greenspring. I'll be joined momentarily by Christina Groff, who's also a CFP and Senior Financial Advisor here. So for those of you who are already clients of Greenspring, great to see you. For those of you who are not clients of the firm yet, I'll share some brief background. Greenspring Advisors is an independent fee-only firm with offices in Maryland, Pennsylvania, and New Jersey, and clients all over the U.S. At Greenspring, our core purpose is to help every person live their ideal life. I don't know about you, but I've heard that paying more taxes is part of many of our clients' ideal life picture here, and taxes are one of the largest lifetime expenses our clients will face. So putting aside tax grumblings, I encourage everyone here to consider these changes as planning opportunities. Tax laws can change, and whenever you hear permanent when it relates to tax law, be aware because taxes change seemingly with each election. For context, the tax law we're talking about today was ratified on July 4th of this year and is also known as One Big Beautiful Bill Act, or OBBBA, or H.R.1. This new law extends some of the provisions of the previous law called the Tax Cuts and Jobs Act of 2017, which were set to sunset at the end of 2025. Our hope is that you walk away with relevant planning opportunities depending on your life stage. There is a lot of misinformation out there about the new law, and we hope to cut through the noise to provide you with clarity. Following our discussion, we're allowing enough time for brief Q&A, so please submit your questions during the webinar today. Thank you to those who have submitted questions in advance. We'll discuss opportunities specific to retirees, small business owners, working professionals, parents. We encourage you to stay tuned in even if the topics don't directly apply to you, because there is a good chance a family member or a friend could use this information at their life stage. So let's get started. I'll kick it off with talking about what you need to know about the tax bill if you're retired. So we received a lot of questions around tax on Social Security and if Social Security is now exempt from tax. Social Security is still subject to tax, and the way Social Security is taxed has not changed. The formula for your provisional or combined income that determines how much of your benefit may be subject to tax stays the same. This formula for provisional or combined income is adjusted gross income plus tax exempt interest plus 50% of your Social Security benefit. The amount of this provisional or combined income that is taxed stays the same. So if you're filing as single and your income is above $34,000, or if you file jointly and your income is above $44,000, up to 85% of your Social Security benefit is taxable. But what has changed is a new temporary deduction for taxpayers who are over 65. Beginning in 2025 through 2028, if you are over age 65, you may be eligible for an additional deduction of $6,000. This deduction is available whether you take the standard deduction or if you itemize. If you are married, you and your spouse would both be eligible, bringing the total deduction to $12,000. If you don't itemize and you take the standard deduction, this would be in addition to the regular standard deduction and the current additional deduction for being over 65. I know it's very confusing, but we do have a graphic that can help make this a little less confusing. Between the regular standard deduction, the current additional deduction for being over 65, and the new $6,000 deduction, a single person 65 could have a deduction of $23,750, and a couple who are filing as married filing jointly, if they're both over 65, you can see they could have a deduction of $46,700. So if you're over 65 and your spouse is not over 65 and therefore not eligible for the $6,000 deduction, the total deduction would be $39,100, as you can see. It's interesting to note that this deduction is actually not available if you file as married filing separately. As I mentioned, this deduction does not impact how Social Security is taxed. So by extension, Because this deduction is not tied to Social Security, if you are 65 or over and you are not yet collecting Social Security, you are still eligible for this deduction. But I keep using the word eligible. So not everyone will be able to take this deduction as it begins to phase out once your income hits $75,000 if you're single or $150,000 if you're filing jointly. The deduction is actually reduced by 6 cents for every dollar over the threshold. So by the time you hit $175,000 of income if you're filing a single, or $250,000 of income if you're filing jointly, you'll be fully phased out of this deduction. And the deduction is also temporary and only available through 2028. So that's a lot of information about the new deduction, Social Security. So what can you do? We just want to mention a few planning items to keep in mind around this deduction. Most importantly, it's managing your tax bracket. It's so key because it's important to understand how strategies like Roth conversions or incurring capital gains may impact your eligibility for the deduction. And also because Social Security is still taxed, keep those tax forms that comes because you'll make sure your records are up to date. So that was the big one. But another item that may impact many retirees is the expansion of the estate tax exemption. For many years accumulating assets, often attention in retirement shifts towards legacy planning. The estate tax exemption is a key component of legacy planning. The federal estate tax exemption is the amount of assets you can give away during your lifetime or at death without incurring federal estate tax. So effective in 2026, the exemption for an individual is $15 million. So a married couple can essentially then transfer $30 million before being subject to federal estate tax. So this amount will be indexed for inflation and will primarily benefit those with really large taxable estates. But as you consider estate and legacy planning, there are a few things to consider. Most importantly, be aware that states have their own exemption amounts, which are often significantly lower than the federal amount. So even if you may not owe federal estate tax, you could be liable for estate tax at the state level. Now, if reducing your taxable estate is a goal, you can take advantage of the annual gift tax exclusion, which is the amount you can gift to an individual within a year without having to report the gift to the IRS and have it count towards your lifetime exemption. This year, that amount is $19,000 and it increases every year. So for example, a couple can gift someone, such as an adult child, $38,000, $19,000 from mom, $19,000 from dad, and there would be no impact to mom and dad's lifetime limit. In a similar vein, there are opportunities to front-end load 5 years worth of gifts to a 529 education savings plan, which is an effective tool to not only help with the cost of education for your heirs, but to remove assets from what otherwise might become a taxable estate. So with the bill and before the $15 million, $30 million if you're married expansion, it was expected that the exemption amount would revert back next year to a much lower number. In anticipation of this, some people may have taken steps to remove assets from their estate by setting up certain types of trusts. If there is a desire to revisit this, you could potentially explore with your attorney if an amended trust is possible and may better suit your needs, but it's very, very important to be cognizant that Congress could change the exemption amount at any point. But estate planning in general is just a really important part of a financial plan. If it's been a while since you've thought about your legacy, this would be a really great time to revisit that conversation with your advisor. When Christina and I were reviewing the questions coming in, the number one question we received was actually around Roth conversions and what the new tax law might mean for that. Roth conversions, just as the background here, are a planning strategy that can be particularly effective in lower income years, which are often the years right after retirement before Social Security and required minimum distributions kick in. So Roth conversion is the process of transferring assets from an IRA or qualified retirement account, paying the tax now, and moving those assets to a Roth IRA, where it will grow tax-free and from which you can make tax-free withdrawals in the future. So the new tax law really does expand the opportunity for Roth conversions, but at the same time, it adds complexity to the strategy. So historically low tax brackets that have been made, permanent for now, the higher standard deduction and the senior deduction are opportunities to incur income at a lower effective tax rate. But particularly between 2025 and 2028, new deduction phase-outs increase the risk of getting caught inadvertently in a high effective marginal bracket. So you may not realize that the Roth conversion, smart planning strategy, where you incurred additional taxable income, puts you in the phase-out range for the over 65 deduction, might have made more Social Security taxable, or pushed you into a bracket where you could incur Medicare surcharges. Now, in many cases, a Roth conversion is still an excellent planning tool, but you just want to make sure you are not hit by unwanted surprises. But, in general, this just highlights the importance of multi-year tax planning, tax bracket management, and precise modeling to avoid pitfalls. So to help you, your advisor at Greenspring can model various Roth conversion scenarios so you can make the best decision around the strategy. Your advisor can also coordinate with your accountant or state attorney to streamline implementation. And it's this type of coordination among your professionals that's also important for not only retirees, but even our small business owner clients, who Christina will discuss next.
Thank you, Molly. I have a question for, before we get to small business owners, just to clarify. So the Roth conversions, anybody can do that, right? You don't have to be a retiree.
Correct.
Yep.
But it was interesting that it was a lot of questions came in wondering, saying, now that I'm retired, I have Social Security income and all these other types of things. Should I be looking at this differently? And the way to look at it differently is to take into consideration some of these new deductions that you might not have had to model in previous years. But yes.
Yep, exactly. Great. Well, for small business owners, this new tax bill really provides some excellent opportunities, and some of it's noise, but some of it is really quite impactful. And where we see the most value is really that coordination with your advisor, your accountant or bookkeeper, and your attorney, both when starting a business, but especially for succession planning purposes and exit planning. So that's really where we see these overarching opportunities that we've highlighted here for our small business owner clients. So first and foremost, this one's in the news, right? The overtime reporting, tips, no tax on overtime, no tax on tips. But what that really means is that some qualified overtime and some qualified tip income is excludable. So the idea is that they may be more willing, or they may be asking you for additional hours when needed. So that's really a great, little piece of this legislation where we do need to be aware of new requirements, and the IRS will provide additional guidance as to the actual reporting documents, so W-2s and 1099s. But really, that's an amazing opportunity for your employees, and some of them may or may not be aware of these new changes. So for overtime specifically, employees would be eligible if their overtime is qualified, and there's a definition for qualified overtime compensation, but excluding up to $12,500 for a single person, $25,000 for married filing jointly. And again, before we're reclassifying employees or trying to get more overtime income eligible for more employees, it's very important to consult your attorney and your accountant before making any reclassification or structural changes for your employees. And tips, same idea. So These are for industries that customarily receive tips. You can't just decide that you want to include tip income if you haven't received it before in your line of work. And again, IRS guidance pending on what that line of work is and who's eligible. But employees can potentially exclude up to $25,000 of qualified tip income, a bit retroactive, so starting from January 2025 onward. So opportunities there, especially for your employees, and ways to engage them in particularly overtime if that impacts your business. So secondly, this middle box here, qualified small business stock, section 1202. So this is a provision that's been around since the Tax Cuts and Jobs Act, but it has been enhanced with the new legislation. So there is a potential for exclusion of part or all of the gain on a sale of a qualified business. And you have to meet certain requirements like a C corporation, and there's a few other things that you need to make sure you have lined up. But what it does effectively is that when you're selling a business that's qualified, depending on how long you've held that business, you have the potential for either a 50% gain exclusion, 75%, or after a 5-year period, up to 100% gain exclusion. So this is an incredible opportunity. And again, not saying to go ahead and take advantage of this, but what we are saying is that it is an opportunity and is something that you want to discuss with your attorney, CPA, and advisor to see if your business qualifies, especially if you're on the horizon for that business sale. And then finally, there's a few other opportunities that we just wanted to highlight to discuss with your team if you're not already taking advantage of them. So the first one, qualified business income, or QBI, has been around for quite a few years now. And what changes is in 2026, there are new higher phase-out ranges for income, meaning you can earn and show more income and take advantage of this qualified business income deduction, which allows you to deduct up to 20% of your qualified business income. So that's a great thing to highlight. That's sticking around because that was on the chopping block for this bill as to what may or may not stick around. So glad to see that stayed. The research and development deduction. So this one is interesting in that, especially for US manufacturers, if you are improving upon a process or developing new technologies, there's an accelerated deduction starting January 1st, 2025. So starting at the beginning of this year, that you can take that deduction sooner than you otherwise would have been able to. And then the clean energy tax incentives. The highlight here really is actually related to timing. So what happened with the clean energy tax incentives is that some of these incentives were actually terminated or the timelines got pushed up. So for example, the clean vehicle credit, which you could be eligible for as an individual person or as a business owner for commercial vehicles, actually moved up that purchase date to September 30th, 2025. So if you were considering adding a fuel efficient vehicle to your fleet or just buying a fuel efficient Tesla or something like that for yourself, that tax credit actually expires September 30, 2025. So that's the soonest deadline that got pushed up. And there are other improvement credits that are on accelerated timelines that you really need to be aware of. And one thing we remind our clients of is more conceptual when it comes to business expenses is just because something's deductible doesn't mean you should always do it just for the deduction, right? Typically that capital or that money that you were going to spend, you were going to spend that anyway, and that was something that you wanted to do, and the tax deduction is a nice benefit. But if you were planning on spending $0 on a clean vehicle this year, then continue to spend $0 on a clean vehicle. So it's not like, I guess it's similar to paying $1 and then you get 40 cents back on your dollar. Well, you've still paid out 60 cents. So that is less than the $1 you could have kept in your pocket the whole time. So anyway, just a note on that. So the pass-through entity tax, if you were already taking advantage of this, this benefit is preserved. Again, this was something that was eligible to be wiped out, but the new bill kept it, where you can effectively pay some of your state and local tax through the entity, subject to specific tax rules for the state. So in discussions with Molly, we were talking about how this is more commonly used in Maryland. It is not a provision that's currently available in Pennsylvania. So you have to check your state rules to see if this is something you can take advantage of. But the benefit's preserved, and at the federal level, they say it's okay from 2025 until 2029. So that was a lot for small business owners. So even if you are not a small business owner, you may still be working for someone else, meaning a working professional, whether small, medium, or large business. So Molly will take us through the next couple points for our working professionals.
Yeah, great. Thanks, Christina. So let's talk now about some of the most important things that working professionals should consider. So first of all, the tax brackets put in place in 2017 that were set to expire have now been made permanent. And permanent, I use air quotes because as Christina has already alluded, almost nothing is permanent when it comes to tax policies. But for now, brackets will stay historically low. And the 10% and 12% brackets are actually now a little wider, meaning more income will be taxed at these lower rates. So that brings up, I did want to mention one item related to these lower rates and capital gains. Because in prior years, the threshold rates for ordinary income and capital gains were really closely aligned. And it was pretty safe to assume that someone in the 12% ordinary income bracket would also be in the 0% capital gains bracket. So these are now less closely aligned. So extra attention should be paid in trying to harvest capital gains in the 0% capital gains bracket so that you don't inadvertently trigger more taxable income. Another big item is the standard deduction, which has been increased, which we went through before, and it will be indexed for inflation. And you can see from the earlier graphic that we outlined the new standard deductions. So that's a big thing. But if you don't take the standard deduction and you itemize, those itemized deductions just got a lot more complicated. One of the biggest headlines of this bill is the increased state and local tax, or SALT deduction as it's known, from a previous cap of $10,000 to a new cap of $40,000. This would be effective for 2025 through 2029, and it will benefit those who itemize and live in high tax states like Maryland. There will be a 1% inflation adjustment to the cap each year, no matter what inflation actually turns out to be. So it's important to note that this additional deduction phases out between $500,000 and $600,000 of adjusted gross income. Once you hit $600,000 of income, the cap drops back to $10,000. So interestingly, this deduction highlights the so-called marriage penalty, as this $40,000 cap applies whether you're filing a single or married filing jointly. And if you're married filing separately, the deduction limit and the phase down threshold is 50% of the other status. So that means, like, what do you do about it? So if you're close to the phase out ranges, it will be important to identify opportunities to avoid incurring additional income so you can keep that income down and preserve your eligibility for the higher SALT deduction, especially if you're in that sort of phase out range or very close. So other things you can consider for doing this are timing of estimated payments and bunching deductions. You may have heard about bunching deductions. It's basically when you take as many tax deductible expenses as you can into a single year to exceed the standard deduction. So in that year, you itemize, and then in the following year, you take the standard deduction, and then you can alternate years of itemizing and taking the standard deduction. One strategy. Recognizing capital gains can add to income. So when possible, develop a plan for timing for taking these gains. Now I mentioned when possible. Sometimes you'll need to take gains if you need money or you need to rebalance, but making sure that you can develop a plan for the timing. Tax loss harvesting, which is a strategy we utilize aggressively for clients during recent market volatility, can be effective for helping to offset capital gains and then in turn keep income low to help maximize your eligibility for this deduction. So another way that itemized deductions is more complicated is that beginning next year, if you're in the highest tax bracket of 37%, deductions will be limited to 35 cents for every dollar versus the current 37 cents for every dollar. So if you're in the highest tax bracket and you're considering the bunching strategy that we just discussed, you'll get more bang for your buck if you bunch deductions this year when you will still receive the benefit of getting 30 cents on the dollar for the deduction. Another big change to look at and be aware of are big changes in charitable deductions that will be effective next year. Probably the biggest thing, or one of the bigger things, is if you itemize, there will be a floor on the deductibility of charitable contributions equal to 0.5% of your adjusted gross income. What this means is that deductions are only allowed to the extent contributions exceed 0.5% of your adjusted gross income. So let's look at an example. So let's say your adjusted gross income is $250,000. You give $20,000 to a charity. You would be able to deduct $18,750 of that donation. And the way it breaks down is 0.5% of $250,000 is $1,250. Subtracting this $1,250 from $20,000 of the gift results in an itemized deduction of $18,750 for the $20,000 gift. Again, that will be starting next year. But also starting next year, something that's new that will be available to all filers is a charitable deduction up to $1,000 if you're single and up to $2,000 if you file married, filing jointly, no matter what your income is. And you don't need to itemize to get this deduction, but it must be a cash donation and contributions to a donor advised fund, which we'll talk about a little bit more later, won't count. So these are a few examples of why a charitable giving strategy is important. If gifting is already part of your financial plan, this may be a great year to make a larger charitable donation that would not be subject to the floor and, if you're in the highest bracket, maximize your deduction. And as Christina mentioned, if it's not part of your plan, it's not that you have to go out and start giving away tons and tons of money to charity, but if it was part of your plan, there's some things that you can look at doing. So one way to implement this, where you would be able to take advantage of the fact that there is no floor this year, would be to implement or establish a donor advised fund. A donor advised fund is a charitable investment account. You can donate your assets, to some of your assets, ideally appreciated securities, take a tax deduction in the year you donate the securities, and make grants to charitable organizations over time. So a donor advised fund really complements the bunching strategy that we talked about. So we talked about the floor and the fact that there will be a new deduction next year. But in light of the changes to charitable deductions, a qualified charitable distribution, or QCD, continues to be a great vehicle for charitable gifting for those over 70 and a half, as there is no floor for those deductions. There wasn't before, and there won't be going forward. If you're not familiar with the concept, a QCD, qualified charitable distribution, is a direct donation to a nonprofit from an IRA. The distribution is not included as income. And if you're subject to a required minimum distribution, the QCD, qualified charitable distribution, contribution can count towards that required minimum distribution, and lower your adjusted gross income on which taxation of Social Security and what Medicare premiums are based on. You can keep that lower. So that's another thing to keep in mind. And just as a reminder, just like we talked about saving your Social Security tax statement, as a reminder, save your charitable receipts too. So to avoid any headaches if you ever need to track those down later. But as you can see from all the changes we discussed, multi-year planning can unlock some great opportunities. Christina is going to examine some additional opportunities that are available for parents.
Yep, thanks, Molly. Before I do that, I just want to remind everyone, if you're on your computer, to submit your questions under the Q&A box. If you're on your phone or you can't find that box, you can also submit questions to info@greenspringadvisors.com. So we have quite a few questions that came in, and then thanks to everyone who submitted questions prior to our webinar. So just a little housekeeping note here that any questions that you'd like us to review, please either put that into the Q&A box or send an email to info@greenspringadvisors.com. Okay, without further ado, for our parents, I am proud to count myself into this category as of about 8 months ago, but I know we have a lot of parents on our webinar today as well. So there were a few changes to specifically 529 plans and federal student loans, and then the new Trump account that is just sort of in the Wild West until we get some clarification from the IRS was also introduced within this bill. So first, we'll talk about 529 plans. So what's new for 529s? Well, there's a little bit that's new, but in addition to some of these items that I'll discuss, just want to reiterate the importance of reviewing the 529 plan in the context of your overall retirement savings and your financial plan to how much to save for college for kids and grandkids. So 529s are great vehicles or containers for that college savings, but there are also other options to save for the future for kids and grandkids. So with that, the changes to 529 plans, we separated here between K through 12, so private education, K through 12, and then there were some higher education college changes to the 529. So specifically for private school K through 12, there are some additional qualified expenses that you can use your 529 to fund. So in the past, you could use the 529 for K through 12 tuition, and it was a pretty tight definition of what a qualified expense was. But now we've expanded that to include not only tuition, but also books and online educational materials, tutoring, educational therapy, and there's a whole list of eligible items for K through 12 expenses. So that's exciting. There's more expansion and additional uses for the 529. So in addition to that, the $10,000 number was around for quite a few years, meaning you could withdraw $10,000 per calendar year from your 529 and pay for your K through 12 expenses. Starting in 2026, that limit now increases to $20,000, which is great, and I think it more closely aligns with the true cost of some private school tuitions. So I was excited to see that. So again, that starts in 2026 for qualified expenses. And then of course, the 529 plans also have a feature that was added in recent years where you can roll over unused funds into a Roth IRA if the beneficiary does not use up all of that 529. So that's just another planning note, nothing new there, but again, just expanding the uses for 529. As it relates to higher education, meaning post-high school education really, is the 529 plan includes some more training and certification in addition to, you can use it for your associate's degree, bachelor's degree, some graduate degree programs, trade schools, and now for, they call it like career certification and licensing. So you can use a 529 for that. And then specifically for the higher education, so the graduate students, there are some changes with the federal student loans. There were some new caps put on how much money you can borrow for a graduate degree program. So think of master's programs, medicine, dentistry, law school, where your federal student loans are capped. You can still go to a bank and get loans that way and pay on your own and get scholarships and fellowships and things like that. But the new caps, for example, for professional graduate students, which would include things like medical school or law school, the federal limit is $50,000 per year with a lifetime cap of $200,000. So for those professionals specifically, you could be running into a ceiling on the federal borrowing that you were not otherwise running into in prior years. So that's one important update. Again, there are solutions to funding those graduate degree programs, but the federal borrowing is what got changed. And then finally, the new Trump account. So this is a new type of individual retirement account, but it's specifically for the benefit of a child. So there are rules about parents not being able to raid the account, which is great, but really it's just an arrow in our quiver. So we're not saying to do or not to do this yet. There's some clarification that needs to be provided by the IRS. But basically, a Trump account is two components. So there's a one-time government contribution of $1,000 for children born between January 1st, 2025 and December 31st of 2028. So just that short window of time, government will say, hey, we'll put $1,000 into this Trump account. In addition to that, you can contribute up to $5,000 per year per child. It doesn't matter who puts that $5,000 in there, it's attached to the child. So $5,000 per child per year. And it does not interfere with other accounts like Roth IRAs, 529 limits, other things like that. So just need to be really clear on the timing of withdrawals, what we're using this money for. And there are certain rules about the types of investments that can be used. They have to be low cost, typically index type funds. But again, there needs to be more clarification on this account type, and administrators and custodians are scrambling to figure out how to actually set up these accounts. So again, we don't have too much guidance on this now, but we're anticipating more as time goes on. So planning opportunity here is considering that seed money if you have a child in that period of time where the $1,000 from the government could be contributed to that account. And then the nuanced discussion really comes into play. Is this account the right place to contribute an additional amount of money above what the government is putting into that account? So all exciting things for our parents as well. So that covers the topics that we had planned for today. So we talked about retirees, small business owners, working professionals, and parents. And now we do have just under 15 minutes for some question and answers. So, oh, here's another little quip. So back to Molly's point, keep your receipts.
Yeah. Actually, Chrissy, yeah, let's take some questions. So one question we received was around the impact the bill might have on nonprofits, which is another big sector. We could probably do a whole section on that, but a few things that nonprofits should be considering with the changes in the tax bill. First, looking at the potential impact of donations. So just as individual donors will have the 0.5% AGI floor beginning next year, corporations will also have a floor, but it will be 1%. So it may mean that smaller and medium-sized businesses may have to pull back on their contributions. Maybe they will, maybe they won't, but that will be a change for them. The change that we talked about in terms of the cap on itemized deductions for those in the highest bracket, that may be among an organization's largest donors, that may impact the level of that donor's giving. That, I don't know if getting the deduction as you were stating, you don't want to necessarily just, if you weren't going to buy a vehicle, just go out and buy one for the deduction, similar here, but that will be a change. And then the new deduction in 2026, allowing non-itemizers to deduct 1,000 or 2,000, depending on how you file, may actually expand the pool of givers, and more, maybe organizations will see people giving that they didn't see in the past. And I mentioned the qualified charitable distributions. They're not impacted by the bill and continue to provide that large benefit for donors over 70.5 with IRAs. So nonprofits may want to continue or even ramp up communication on the tax benefits of a QCD to their targeted donors. And just in general, probably want to review how a nonprofit may want to review how they communicate with donors. So for example, often education and arts are funded by high income donors. These donors may appreciate communication around how 2025 is a great year to make a large donation. Religious institutions, on the other hand, tend to be more middle income donors. So their donors may appreciate learning more about the charitable deduction that begins in 2026. So that's on the donor side, but there are a few administrative things that may change for nonprofits or impact them. One is probably somewhat rare, but the excise tax on highly compensated employees at nonprofits has been expanded. More people may be considered part of that category now. So if a nonprofit has a large number of very highly compensated employees, they may want to just be aware so that they can take another look at the budget or see how maybe the compensation plan might need to be adjusted. But probably the big one that's made some news is also the increase in net investment income tax on colleges and university endowments that may prompt some investment committees to look at how investments are structured to make sure they are enhancing their tax efficiency, because now their net investment income will be taxed, some of them, depending on the institution and how large the endowment is, at higher rates. So that was a great question. Thanks for that one. Christina, did you see any other questions?
I did, Molly, and these are somewhat related to the charitable piece. So we can talk through these, but just talking about looks like the interplay between using a qualified charitable distribution, so QCD, versus the additional charitable deduction beginning in 2026. So the way I see it, and Molly, feel free to jump in here too, but the way I see it specifically for the additional charitable deduction is if you're not itemizing and you're giving to charity, in the past, you wouldn't have been able to deduct any of those gifts, but now you will be able to. And that's available for everybody, not just people who are aged 70.5 or older. Whereas the qualified charitable distribution is really for IRA holders aged 70.5 and older, where instead of taking your full required minimum distribution, you break off a piece of that and send it to charity. So it kind of accomplishes the same thing. It's just a different method. And again, the limits are different for those two things. So you have a limit for how many QCDs you can do and the amount of money you can give. And then if you're not itemizing, you have a limit for how much charitable deduction you can take. So I hope that answered that question, but that's just kind of the difference between the two strategies.
Right. Let's see, there was another question about AMT. Were there any changes to the alternative minimum tax or AMT? So what is AMT? AMT is a parallel tax system designed so people with high incomes pay a minimum amount of tax, even if they utilize numerous deductions or credits under the regular tax system. So back in 2017, when personal exemptions went away and the SALT, state and local tax deduction, was initially capped to the $10,000, very few people had to worry about getting caught up in AMT. Starting in 2026, the AMT exemption phase-out threshold, it's a very intricate calculation, but there's exemption phase-out thresholds and phase-out rates. Those will change slightly. So what does it mean? The result could be a moderate increase in the likelihood of people who might have some AMT exposure. Again, very probably small number, but would be somewhat of an increase from before. And while this probably doesn't impact a lot of people, if you have unexercised incentive stock options or ISOs that are subject to AMT, you could consider exercising them before the end of 2025, before the change takes effect, because those, as I mentioned, those thresholds and rates change starting next year.
Great. And Molly, I have a question here, which I can answer. Changes to premium tax credit and HSAs. So for healthcare related items, there are a few updates from the legislation, specifically for HSAs, health savings accounts. Now, so most of the rules stay the same, but now if you are someone who has retired quote unquote early, meaning you're not yet on Medicare, but you don't have an employer plan, you're kind of in this in-between valley where you need health coverage for a couple years. So some of our clients will purchase coverage out on the ACA or the marketplace plans. And the new One Big Beautiful Bill Act allows for an HSA under all bronze and catastrophic plans on the exchange, which is great, meaning you may be able to contribute to an HSA when you previously did not have that option. So just reevaluate that. The premium tax credit is the piece of your premium that you pay on the exchange where you get that back in the form of a tax credit subject to your income limits. So again, this is an important change for 2026. If nothing's done by Congress through the end of the year, we're looking at a cliff, whereas it used to be more of a nice hill where you could still take some of the premium tax credit. So we need to be really mindful of income for 2025, 2026, and going forward, where you may have previously gotten some of that premium tax credit, and now you may or may not be eligible. So something to evaluate. Again, looking at your income, putting together a plan for that, and making sure it's pretty accurate as far as your income estimates when you're on an exchange plan. And then taking a fresh look at some of those bronze and catastrophic plans with that HSA benefit. And also COBRA for our early retirees, where you can continue your health coverage from your previous employer. It gets more expensive because your previous employer isn't paying. You're taking all of that as an expense yourself, but it's an option for health coverage if you're retiring before Medicare age. So looks like we've got a few more minutes. Molly, I see another published question here about rolling a 529 into a Roth IRA. So like we talked about, unused funds in the 529 can go into a Roth IRA. The question has to do with, is there a dollar limit of the balance that isn't used for education per year, or can you roll it over all at once? So I can take part of that question, but the rollover of the $35,000 can't be done all at once. It's subject to the Roth IRA limits for that tax year. So for 2025, it's $7,000, and it's typically increased a bit with inflation over the years. So logistically speaking, my understanding is that 35,000 can't be rolled over in one tax year. You kind of have to piecemeal it out till you get to your limit. So Molly, anything else to add there?
No, I don't think so. I think it's one of those things to always be, stay tuned, because you never know what rules might change in the future too. Because that was a fairly new rule, and a lot of times you get more clear as a new rule as a rule comes out. People have questions, and not all the questions were answered in the original writing of the bill, so things get clarified later. But that's my understanding as well. I think I have time for one more question. This one is one that came in from all the gamblers out there. The wagering loss provision will be changed beginning in 2026. So previously, you could claim up to 100% of gambling losses. This now will be reduced to 90%. So for example, let's say next year you take a few trips to Vegas and you look back to find you have 100,000 in winnings, but also $100,000 in losses for the year. So in 2026 and beyond, you would only be able to deduct 90,000 of the losses to offset the $100,000 in winnings. So that leaves you with $10,000 of taxable income, even though your net income from gambling, you basically walked away with zero. So that's not great for gamblers. But if you see any, do you have any other questions, Chrissy? I know we have about 1 more minute left.
I don't. I think that I'm just reviewing the queue, and it looks like we addressed most of those. Oh, we got one here at the end. So finance charges for new automobiles in the bill. So yes, asking about when you're financing a new car, there's a provision in there. And Molly, I'm not sure if you have any notes about that, but
yeah. So that if you, I believe that's the interest deduction that you can now, if you borrow to purchase a new car, you can deduct up, and you take a loan out, you can deduct up to $10,000 of interest. There are some rules around it. The car needs to be, I think, like under 14,000 pounds. So, you know, a truck or SUV, that would count, but your RV wouldn't. So it's really geared towards cars. And what else would I say about that? So the vehicle, the final assembly needs to be done in the United States. So, you know, it doesn't necessarily mean you want to finance a car. Financing a car might not be the right thing for you. But if you were planning to finance a car, then just keep in mind that the interest can be deductible. And I believe there is an income limit on that. And I think check me if I'm wrong, but I think it's $150,000 if you're file a single, and $250,000 for married filing jointly. So basically, if you're phased out, so if your income is past those ranges, depending on if you're single or married filing jointly, then you would not be eligible for this deduction that you could take for this. It's in place for this year through 2028. It's one of those sort of temporary type deductions that we talked about, those temporary measures.
Great. Thanks, Molly. Looks like that's all the questions that we have, so we can close out. And yeah, thanks everyone for joining us.
Sure. So, you know, the new tax bill was almost 900 pages. And while we have obviously not covered everything, we hope that you have a better understanding of the changes, how you may be impacted, and what you can do to maximize your tax efficiency. Tax laws and rates change all the time, as we've seen. So it's important to stay up to date as the tax landscape changes. At Greenspring, we're paying attention to all of this, so you don't have to. If you're currently a client and have questions, we encourage you to reach out to your advisor to discuss your specific situation. If you don't have an advisor, we invite you to reach out to us to start a conversation. But Chrissy, I'm sure you'll join me in thanking everybody for their time today and for tuning in. Nothing like spending a good hour of your day talking about taxes. Time flies,
thanks,
right?
Everyone. It does. Yep. Thanks, everyone. Hope you have a great day.